Good morning. Welcome one and all for our regular second Saturday presentation. Hope audio is clear. So initially we will see current market scenario presentation followed by recommendations. Then we have technical charts, 3 charts I am going to show. Thereby you can understand where the support and resistance are. Finally, we can have question answer session. Just when markets were discounting the US Fed rate hike, which is going to happen on March 16th, that is on Wednesday, suddenly market got jolted by an unexpected negative news of Russia invading Ukraine. No one was expecting this invasion. There was news that Russia was building its military forces near Ukraine border, but no one was expecting a war on Ukraine. But US was consistently warning that anytime Russia may attack Ukraine. That has finally happened. So the market got jolted because of this negative news. Globally, every market fell, whereas commodity market went up because of some valid reasons, whereas the stock markets across the world fell very sharply because of this news. The other news is the relentless selling by foreign investors. Even before the war, foreign investors were consistently selling in our market on one hand, whereas the market got supported from domestic institutions. They were consistently matching buying from the selling of foreign investors. Whereas once the war started, the selling intensified further. And if you see 3 days back, they were selling more than 1 billion per day. Just in the last 2 days, the selling intensity has come down. Previously, there was heavy selling by foreign institutional investors. Crude oil and commodities up sharply. There is some valid reasons why they are up. I will explain in coming slides why crude oil and commodities were up. And it is negative for our economy, particularly our Indian economy. It is very negative because we import almost 85% of our crude oil needs. And this time world is facing a new type of crisis. The last 15 years, if you see, in 2008, the global financial crisis, that was different. Then we saw in 2020 where COVID came, that crisis was different. And now what we are facing is a different type of crisis where it's very difficult for the central banks to sort it out. In both the previous crises in 2008 and 2020, globally, most of the developed central banks, what they did was they printed money, announced quantitative easing, and rescued the world. But this time it is not possible because at that time the inflation was very less. They did it, but this time the inflation is very high. So you cannot use quantitative easing or high liquidity to rescue the world. The world is facing a new type of crisis. We have to see how they are going to sort it out. So the commodity and crude oil prices up sharply, and on one hand, on the other hand, US Fed is going to increase the interest rates. So we are going to have a stagflation threat for the global economy. If you see in the last 2 days, 3 days, many economists in TV started using this word stagflation, which is nothing but inflation going up, whereas economy will remain dull, and that is called stagflation. And it is very negative for the economy. We have to see whether it pans out or not. But anyway, some warning signs we are getting from many economists that world is entering towards the stagflation, and only time will have the answer. And if you see the last 1 month, Nifty and Sensex fell by around 4%, whereas Nifty mid cap and small cap, they were down by around 5%. So overall, it's a very negative market for the last 1 month. We are seeing some stability in the last 2 days in our markets where some buying has been happening, and the panic sell-off, it has been over for time being. So the major big headlines, that Russia has invaded Ukraine. So many of them will be knowing why Russia has invaded Ukraine. But for some of the clients, just I will briefly explain the reason of why Russia has invaded Ukraine. We all know that the World War happened during 1940s, where world divided into two groups of countries and they attacked each other. And World War ended in 1948-49 range. So post World War end, many European countries felt that there was a real threat of Soviet Union attacking their countries. So they formed an organization called NATO, North Atlantic Treaty Organization, where they combine together. If suppose Soviet Union attack their country, these members of the NATO will collectively use their military power to fight against Russia. That was the main reason of formation of NATO in 1949, just after the end of the World War. And post NATO formation, there was no big major war on in the international level on any countries. So the NATO was the time was going on. Only the Cold War was there between US and USSR in the last 50-60 years till 1991, where USSR got collapsed. After the collapse of USSR in 1991, many small countries happened. Russia was the biggest one in that. Ukraine is also one of the country which was formed post Soviet Union collapse. Previously, it was a part of Soviet Union. Once it got fractured, then Ukraine became a separate country, and many small countries from in the Russian region, they were given independence, and they were separately became a sovereign country. But NATO, what they were doing during these years was that they were silently adding the members in the group, and some of the countries which were in the erstwhile Soviet Union group, they started joining the NATO. Russia felt that it is not good for their security concern for long term, and even Ukraine also showed their intention that they were willing to join NATO. So once Ukraine joins NATO, means then Russia felt that it won't be good, because the big border of Ukraine will come near to the Russia. So Russia, before Ukraine joining NATO, Russia started attacking the Ukraine. And this is the map. If you see that, this is the Russia map, and here it is the big Ukraine country. And some of the countries like Lithuania, Latvia, Estonia, which were previously the erstwhile in USSR, they all joined NATO. Poland also joined NATO, and Romania also joined NATO. And Belarus is in the control of Russia. Belarus still supports Russia only. They did not join NATO. Whereas once if Ukraine joins NATO, means then NATO forces will come near to Russia. And if suppose any problem happens, means they can easily attack Russia. So because of this threat only, Russia started war against Ukraine. What they are finally going to do is that they will put a president in Ukraine where he will listen to Russia rather than to NATO or West forces, that is European countries. That will be the final end game, but it will take some time, because West and the US is not going to take it lightly. Some Cold War like that is going to happen for many months and years. So immediately after the Russia attacked Ukraine, the West and America started putting sanctions. Sanction is nothing but a penalty imposed by one country and another for breaking international law. It is basically designed to hurt a country's economy, which is attacking. If you see in the history, many countries US has put sanction. We all heard about that a sanction was imposed on Iraq because they invaded Kuwait. Similarly, on North Korea for their nuclear weapon program. Similarly, sanctions was imposed on Iran also. And if you see, even on India, US has put sanctions in 1998. Because we tested one nuclear weapon in 1998 during Vajpayee government. At that time, US put a sanction on India because they told that it is against international law for testing the nuclear weapon. And since we tested at that time, US put sanctions on India at that time. So because of these sanctions they put on Russia, Russian economy is going to affect in coming days. And initially, what they did on sanction was that the Western nations, they have frozen the assets of Russia's central bank. Russia is having almost $630 billion worth of foreign reserves. Around 20% is in the form of gold and balance in the form of euro and in dollars they are having. And once they frozen the Russia central bank assets, what will happen is that they could not be able to access the currency reserves of the Russia. And then the US, UK, and European Union, they banned businesses from dealing with Russian central bank. And many companies, if you see that US-based companies like Google, Facebook, everyone stopped their services in the Russia. Like that, many companies one by one they are stopping their business in Russia. So basically, Russia is going to get affected in near term because they are getting cut off from the global businesses. And if you see that Russian banks, they were removed from SWIFT messaging system, which means if you import or export with Russia, then payments will become very difficult. Which indirectly means that it will be very difficult to make exports and imports into Russia. These are some of the sanctions which has been announced post-war, and more sanctions they are going to announce it from here on. And if you see that, one of the important thing is that US has announced the sanctions on oil and gas from Russia, whereas the European Union, they did not till now not yet sanctioned the oil and gas trades from Russia. The first reflection we got because of the war is in the crude oil prices. Crude oil prices, which was trading below $100 for many years from 2014. Because of this news, crude oil went up very sharply. Even it went up to $130, $130, and now it has cooled a little bit to around $112, $113. And if you see historically, 2-3 times crude oil prices went up very sharply in the last 25 years, I am telling. In 2006-7, if you see, that price went up from from around $60 to $140 in the matter of 1 year. That is basically mainly because of huge demand at that time. Globally, economy was doing very well at that time. Almost all countries were doing very well, which led to huge demand for crude oil, and crude oil prices went up very sharply. And post to that, global financial crisis came, and demand got distracted, and crude oil prices fell very sharply. Again, it saw bounce back. And then if you see in 2015, the crude oil prices fell very sharply. This time the fall was mainly because of huge supply from US, which was heavily importing crude oil. They developed their own ways of crude oil exploration, that is shale gas and shale oil. They started exploring, which led to huge demand destruction from US clients, and that led to the huge fall in crude oil prices in 2014 onwards, just when Modi government came. From there, crude oil was trading around $80 to $60 in majority of time. And now, because of the war, the crude oil prices went up very sharply. So there is some valid reason why the crude oil prices went up. I will tell in the next slide. It is not only the crude oil, the other commodities also went up very sharply. Many commodities. The reason is that Russia is one of the world's largest exporter of natural gas, then steel, nickel, and palladium. These are the world's largest exporter from Russia. These products are exported from Russia, and they are the world's largest exporter. And if you see crude oil and coal, Russia is the third largest exporter. Suppose if once a big supplier is got blocked because of sanctions imposed on that country, naturally there will be a short supply of that product and price will go up. It's natural that whenever a big supplier is stopped, price will go up, and that has happened now because of Western countries and Europe, US putting sanctions on Russia, and there is a big global supply shock of many metals, and price has gone up very sharply. And interestingly, what you see is that oil and gas is not in the sanction list. for at least from Europe. US has banned it because they don't import much from Russia, so they are not affected. So they banned oil and gas import from Russia. But European countries at present they are not in a situation to ban oil and gas from Russia, because almost the entire Europe depends upon oil and gas from Russia. If they put sanction, means they have to find the other buyer, which is not possible in the immediate term. So they did not put any sanctions on oil and gas from the Russia. Suppose if any sanctions comes from European countries, means then price will go up further very sharply from here, at least in the near term. And this is the Russia's global share of products, global production. Palladium, if you see, almost 44% of global palladium production is from Russia. Natural gas 16%, and platinum, if you see, it is 14%. Oil 12%, wheat 11%, nickel 6%, aluminum 6%, coal and copper around 5%. And if you see that palladium almost 44%, which is mainly used in automobiles, that palladium is used, and price has gone up very sharply because you are blocking a producer. Almost half of the global production is going out of the market. That means the price, naturally a huge shortage will happen and price will go up, and that is the reason why palladium has gone up very sharply. And oil, if you see, 12% of global production is from Russia, and that is why oil has gone up. Natural gas 16%. That is a very huge market share for Russia, and because of that, natural gas price also has gone up very sharply. Nickel 6% global share is there. We all know that nickel prices went up 100% in a single day in London Metal Exchange because of supply issues, as well as because of technical issue of overshot in that short covering in the nickel. That led to sharp increase in the nickel prices in the London Metal Exchange. And all other materials, aluminum, coal, copper, everything is going up because of a big major producer is getting blocked from the global market. So what is going to the impact of the war? The first one is it is going to be highly inflationary. In the last 2 weeks, 3 weeks, we are seeing that all the commodities, crude oil, coal, everything has gone up, and it is definitely going to reflect in the inflation in coming months. It will have a 2 months to 3 months lag, and definitely it is going to be reflecting in the inflation throughout the world because of the sharp increase in the energy price as well as in the metal commodity prices. Second thing is, it is going to be the European economy which may be affected more than anyone else apart from Russia, because Europe they import a lot of energy, that is crude and natural gas from the Russia. So from here on, it is not going to be the smooth trading between Europe and Russia. There will always be some issues for payment and other issues, which means that European economy has to shell out higher price for their energy, both natural gas and oil, which will affect Europe much more than any other country, because they are, as far as the oil and gas is concerned, they are the biggest partner for Russia. Indian economy, we are also going to get affected because basically on the commodity front, crude oil prices has gone up sharply. We as a country import almost 85% of our crude oil need, and any increase in the crude oil prices is going to affect us a lot, and I will tell in coming slide that how much we are going to get affected. Russian economy, it is almost getting cut from the global trading, which means they will also get affected a lot, and we have to see how long the Russia can how long Russia will can manage with this sanction. And finally, the interesting part is that the US economy will be relatively less impacted among all countries, because their trading with Russia is much less. They don't import any oil and gas, just 2% or something they are importing from Russia. So even if they stop it, it is not going to affect it. And among all the economy, US economy will be relatively less affected because of this war. And this is the European countries. How this shows how much they depend on the Russian gas supply. If you see the countries like Macedonia, which is a small one, Bosnia Herzegovina, these are very small one. Moldova, these are very small countries. They depend almost 100% of Russian gas. Finland 94%, Latvia 93%. And if you see among big countries, Germany, almost half of its gas demand is satisfied from the Russia. There is a dedicated pipeline between Russia and Germany, where Russia used to supply natural gas to Germany. Suppose if German puts sanction on oil and gas from Russia, means then where they will get their 49% of their natural gas from where they will get, it will be very difficult to find the alternate country in near term. It will take 4 years, 5 years to fill the gap of Russia, and it will happen gradually only. So that is why German categorically told that they will continue to buy from Russia. Immediately they won't stop it. Italy, almost 46% of its natural gas needs it imports from Russia. Poland 40%, France 24%, Netherlands 11%, and Romania 10%. Interestingly, if you see that UK, they don't depend upon, that is Great Britain, England, and all, they don't depend upon the Russian gas. They mainly import from Norway. That is why their name is not in the list. Whereas some of the countries like Germany and all, they heavily depend on Russia, and it looks that German economy may get affected in near term because of the current war. Anyway, German has to gradually reduce its buying from Russia, and for that they have to pay higher price from alternate sources, which will affect their economy. So it is going to be the Europe which will get affected more because of this war. And India, if you see that, India will get affected because of this, because of the sharp increase in the crude oil prices. We all know that in India only 3 producers of crude oil are there. One is the ONGC, the other one is the Oil India. Both are government PSUs. The third one is the Cane India, where it is with the Vedanta group now. Only 3 producers are there of crude oil in India. They satisfy almost 15% of our crude oil needs. Balance 85%, we buy it from other foreign countries, mainly from Gulf regions and from some African countries. Also, we used to buy it. And from Russia, our market, we used to import just 1 to 2% of our crude oil needs from Russia, because the transportation from Russia is little difficult. If you import from Gulf countries, you can easily import it through sea, you can import it. Whereas if you want to buy crude oil from Russia, means then transportation has some issues, because we don't have a direct sea link between Russia and India. That is the reason why India is not buying from Russia. The other reason is that Indian refineries, majority of them are designed to refine only the Gulf crude oils. Russia, which is a heavy crude oil, it may need some modification in our refinery to process that oil. Some of the oil, like Canadian oil and all, Indian refineries are not equipped to refine it. Similarly, shale oil also, our refineries are not equipped to refine. We have to make some modification in our refineries to refine that oil. For that reason, India imports majority of it from Gulf region only. So since we import almost 85% of our crude oil needs, every increase in dollar, it will significantly affect us, because we have to pay in dollar terms. For example, just 2 months back, we imported around $70 per barrel. So when we import a barrel of crude oil from any country, we gave $70. Now, yesterday it was $110. That means for the same quantity of crude oil of 1 barrel, we have to give now $110. That means $40 extra we have to shell it out when compared to few months back. That means $40 of money will move out of our country. Suppose that money stayed in our country, means that would have been used for some other purpose. Basically, if you see crude oil, there are 3 parties domestically. One is the government, the second one is the consumers like us, and third is the oil companies. Oil companies, I am telling both ONGC and oil marketing company. So naturally, three parties are there. And if you see any increase in the crude oil prices, among the three has to share it. There is no other way, because all the three has to share it. How government can share? They are putting taxes on crude oil through excise and customs duty. That they may have to take a hit on that. They may have to reduce it. Otherwise, a steep increase in the prices of crude oil, economy cannot manage it. The second is the consumers. So petrol prices and diesel prices are going to go up, and naturally we have to pay higher prices for filling our auto tanks, and we have to give more money for buying petrol and diesel. And third one is the oil companies, where HPCL, BPCL, IOC on one hand, then ONGC and Oil India another hand. So beyond certain point, what will happen is that government will not give higher price to companies like ONGC and all. Even if crude oil goes to 150, the government will give only $90 to ONGC for their crude oil, because the crude oil from ONGC and imported crude oil, they will mix together and they will find a blended rate, and they will charge for the oil marketing companies. Previously, it has happened in 2007, 6 and all. It happened when crude oil went up very sharply. Government did not give huge prices to market prices to ONGC. At that time, government maximum gave only $65 to ONGC, in spite of oil going to $120, $130 in the international market. So similar thing can happen in India also, which means oil companies will take a hit. Consumers has to bear some burden, and government has to bear some burden. So overall, all the three parties has to take the hit from that. But money is going out of the country. If consumer is having that money, means they would have spent for some other purposes. Similarly, government, if they have got higher excess duty, means they would have spent it for laying roads or for some other purpose. Oil companies, that money they would have spent it for capex plan. So any increase in oil prices is basically negative for our country, because if that money is available here, means it would have been spent for some other purpose, which would have been helpful to our economy. And now money is going out of country. I made a rough calculation in that. And if you see that, if there is an average $30 increase in prices, so last year the price was around $75. $75 is the average crude oil prices we imported. And in the next year, government has budgeted $80. Right now we are around $110. That is almost a $30 increase in oil prices against the budgeted one, which means around 2.3 lakh crore will move out of our country if oil price stays in this range. So that is the hit we have to take it if crude oil stays above $100. And only time knows whether crude oil price will go up or come down if war escalates, or if Europe puts sanctions on oil and gas on Russia. That is the thing. But oil analysts, what they are telling is that very experienced oil analysts, what they are telling is that above $120 crude oil price will not sustain, and it will gradually come to $80. That is what the oil analysts are telling. And we have to see, if the war ends, means then oil price will start falling, and it will stay around $100 for time being. So impact of higher crude oil prices and commodity prices, if you see that, first, inflation is going to go up. Already our wholesale inflation is above 14%. And since RBI is not looking into wholesale WPI inflation, wholesale price inflation, no interest rate has been hiked, but it is around 14%. And if inflation goes up, means interest rate will also will go up. And it is expected that in April RBI policy meet, the RBI very likely to increase the interest rate. The second thing is the rupee will weaken, because all the crude oil are made in payment made in dollars, and since we are importing around 100 billion worth of crude oil, when prices goes up, extra money we have to shell out in a dollar, which will weaken rupee. And the current account deficit also will go up because of that. The third important thing which will happen at the micro level is the working capital need will go up for many of the companies because of increase in crude oil prices and other commodity prices. between 2014 to 17, many of them will know that crude oil prices fell very sharply. And if you see that many mid-cap companies became became debt-free at that time, mainly because they mainly because the working capital needed was very less. I will give an example. I will give one example. Steel, you take steel. 50 rupees is the 1 kg steel. A company had 100 kg of inventory in steel, means he needs just 5,000 rupees for keeping that steel. Suppose if steel price goes to 100 rupees, from 50 rupees to 100 rupees, then for the same amount of steel to keep as an inventory, he needs 10,000 rupees. So additional 5,000 rupees he need as an working capital. So whenever a commodity price goes up very sharply, you need a higher working capital. Between 2013, 14 to 17, many mid-cap companies became debt-free, mainly for the reason that their working capital got reduced because of lower commodity and crude oil prices. Now the reverse is happening. That means more working capital will be needed for many companies because of the sharp increase in the crude oil and commodity prices. Now we have entered a very interesting situation globally. Inflation, we all know that what is meant by inflation. In India, we born with inflation, we live with inflation, and we die with inflation. If you see in the last 10 years, a majority of product prices have gone up, but it is not the same situation in many of the other countries. I still remember that 10 years back, in 2010 to 2010 time, 10 years back, I used to buy Ashirwad Atta at 28 rupees per kg. 1 kg of Ashirwad Atta. The same 1 kg now is at more than 60 rupees. That means price got doubled in the last 10 12 years. Similarly, 10 years back, I used to take a coffee or tea at 5 rupees only per glass. Now it has gone to 10 rupees. That means price has doubled in the last 10 years. So if you see any products in India where a common man uses, price used to go up because we have inflation. But if you take any European countries or in Japan or some other countries, they generally don't used to have inflation. Whatever price you gave 10 years back, the same price you used to give now also. Their inflation used to be 1%, 1.5% like that. Whereas in India, we used to have a huge inflation. If you go to Japan, the soap which you bought, the price of the soap which you bought 30 years ago and now will remain the same. The price hasn't gone up. Because in Japan, there is no inflation. Whereas if you see in India, the price has gone up 2 times, 3 times in the last 20, 30 years. Because the inflation comes with us in India. There are 2 reasons why inflation goes up. One is because of a higher demand, and the second one is because of shortage in supply. In India, the main problem of the inflation is because of the demand side. Since our population used to go up consistently every year, there is always a need of higher products, because population as they get older, they used to consume more till certain age, and the product demand used to go up. So the product production has to keep pace with the demand going up. Since the Indian government used to run with higher fiscal deficit, the money supply used to be much higher than the production level. So we used to have a higher inflation. So whenever inflation goes up, whether in India or globally, because of demand side, what government used to do, any central government used to do is that they used to increase the interest rate. That is called monetary action. Plus, government also has some leeway to reduce the demand side by cooling the economy, by reducing the spending. That is by RBI increasing the interest rate, and government reducing the spending, which will reduce the demand, which will bring down the inflation. Even now, if you see that next week, US Fed is going to increase the interest rate because their inflation has gone up, mainly because of demand side. They pumped a lot of money during the COVID time, which increased the demand for many products, which fuel the inflation. And that is the reason why they want to slow down the economy to reduce the inflation. The second way why the inflation used to go up is because of any supply disruption, which is the supply side inflation. Now it has happened now. See, Russia suddenly going to stop exporting its palladium. Means globally the supply of palladium will come down. Russia, which is one of the largest, Russia and Ukraine combined together, which is one of the largest exporter of wheat, they are going to stop wheat exports. Means suddenly wheat demand globally will go up. Price will go up, not because of demand, but because of less supply. And wheat prices, if you see in the international market, it has gone up very sharply. In the last 1 year, the price has gone up by almost 100%. And in the last 1 month, wheat prices has gone up very sharply. And this is because of supply side issue. And this can be tackled not by reducing interest rates or not by increasing interest rates or by reducing government spending. But supply side inflation can be sorted out only by boosting supply only. We cannot reduce inflation, which is based on supply side, by increasing the interest rate. So now what is going to happen is that on one hand, US Fed is going to interest rate to cool down the demand, to reduce demand side inflation. On another side, the supply side inflation is going up. So it is going to be the double whammy for the global economy. Where that is why many of the global economists are predicting a stage which is called stagflation. In 1970s, US had this stagflation, which is nothing but the inflation will go up because of a supply shock, whereas economic growth will come down because the US Fed is going to increase the interest rate, and then they are going to stop the quantitative easing. They are going to shrink the balance sheet, which means that they want the economic growth to slow down, whereas inflation will go up because of supply side issue, which will combine together will create unemployment. This is what many economists are predicting, but only time has the answer. This is one of the scenario where the current situation is there, but we don't. Only time will tell whether stagflation will come or not. So this time it is going to be different. As I told that in 2008, the global financial crisis time, all central banks, European Central Bank, US Fed, they all did quantitative easing and they gave huge liquidity to banks, and they rescued many weak banks and finance institutions, and they somehow recovered the global economy. Similarly, in 2020 COVID crisis time, similarly central banks injected a lot of liquidity. They widened the balance sheet heavily by giving big quantitative easing, which helped the economy to recover. But this time it is not going to happen, because this time the inflation is very high, whereas in 2008 and 2020 time the inflation much was not there. But this time already 7.9% is the US inflation, which is expected to break the 10% mark in coming months. And already 7.9% is the 40-year high inflation in US. And it is expected that in next few months, the US inflation will cross 10%. And during that time, interest rate cannot be reduced because inflation is very high. Similarly, you cannot inject more liquidity also because of very high inflation rate. So the role of central banks will be much less in current crisis. So the only way to reduce the inflation will be by sorting out the supply side, which will happen only by compromising between Ukraine and Russia. So RBI, what they are going to do now, we have to see it. But one interesting thing is that in spite of all this global crisis we have seen in the last 2 weeks, 3 weeks, Bond yield did not spike. It has been relatively stable, so it is a big surprise. Rupee is also relatively stable, though it has weakened a little bit, but relatively stable when we compare to previous crisis. In previous time, rupee and bond yield weakened significantly, but this time it is relatively stable, at least till now. But RBI, once US Fed starts hiking the rates, means RBI has no other choice. It has to hike rates. Otherwise, the rupee will start weaken, and the FII flow will again go out, at least from the bond market. The good positive point is that we have good forex reserves, record forex reserves we are having, which will be helpful to deal the crisis. So on macro economy, except inflation, the bond yield, rupee are very stable. So that is one big positive for our country. So the long-term impact of higher crude oil prices, if you see that, suppose if crude oil stays above 100 for 2 years, 3 years, like that, means basically it will have impact. What is going to happen is that the prolonged higher crude oil prices will be negative for crude oil itself. If crude oil prices stays very high for many months or years, means it will be negative for the crude oil itself. I still remember that in 2003 to 2007, crude oil prices went up very sharply from $30 to $140. US felt that the crude oil prices was very high. They were majoritarily importing from other countries. They felt that crude oil prices were very high. So at that time, really, they started exploring the shale gas and shale oil. They started making huge investment in that sector for 5 years, from 2008 to 2012-13. They made huge billions of dollars in that. They felt that importing higher crude oil prices will be at very high rate, will be negative for US economy. So they felt that domestically it should be made available, and they invested hundreds of billions of dollars in shale oil and gas. And from 2014 onwards, these projects started yielding oil and gas, where US became self-sufficient. And because of their huge investment between 2008 to 13, crude oil prices fell very sharply from 2014 onwards. At one point of time, even crude oil went to negative 2 years back because of a huge supply in the market. So if crude oil prices remains high for 1 year or 2 months, then countries will start searching for alternate products, or otherwise they will search more oil in their own country, which will lead to higher supply. So crude oil prices remain at higher prices, means it will be negative for crude oil itself. The second important thing is that already the electric vehicle adoption has started, and it will get speeded up more if crude oil prices remains at that level. Countries like India, where we import a lot of crude oil, we will start focusing on solar electricity power generation, because coal power generation, already the coal prices are very high. And if you see that, once if we start generating more electric power through solar, means that power can be used for electric vehicle usage, which is the green energy, which is called, and electric vehicle adoption will get speeded up, and more power efficient products will be innovated. And if you see that in the next 1 to 2 years, the electric vehicle adoption will get speeded up if crude oil prices remain at higher level. And domestic sector impact, if you see, because of the current war is there, IT and pharma, we feel it will unlikely to be impacted much. And IT, we are expecting some consolidation to happen in near term. It will neither go up or come down. Some consolidation will happen. Pharma, it has seen a very good correction in the last 4 or 5 months. I'm expecting pharma stocks to do well in coming months. FMCG, the impact will be limited. Some of the raw material prices has gone up, but they have pricing power. Many companies have pricing power in FMCG. They will gradually pass on the higher prices, so the impact will be limited. Whereas if you see in the autos, cement and consumer discretionary, where steels and all used, they may get affected more. Autos, if you see that almost the entire thing has affected. Price has gone up. Steel prices has gone up. Aluminum prices has gone up. palladium, which is mainly used in auto sector, that has gone up. Uh, finally, the fuel prices is going to go up, which is very negative for auto sector. That is why the Maruti, Tata Motor, everything has come down, and even semiconductor shortage, which is expected to get sorted out in current year. Now they are telling that it may get postponed to another 1 year. Another 1 year, we may see the semiconductor shortage. So auto is going to get affected more. Cement, they need lot of power to manufacture cement, and power is generated through thermal power plant. Now coal prices has gone up very sharply, so the cost of production of cement will go up, which means they have to increase the cement prices. Initially, there may be some reluctance from the buyer to buy cement at a higher price, but gradually they will pass on. So in the intermediate time, it is going to be the tough time for cement producers. Consumer discretionaries, for example, washing machine manufacturers, air conditioner manufacturer, refrigerator manufacturer, fan manufacturer, they will all get affected because of higher commodity prices, and it will take some time to pass on the higher cost to the consumers. Till then, it will get affected. So IT and pharma, we feel that it will the impact will not be there. FMCG, the impact will be very limited, whereas auto, cement, and consumer discretionary, the impact will be higher. The other important thing where it has been very debated very nicely is the foreign portfolio investors. They have been continuously selling in our market, and if you see that in the current financial year, that is from April to March FY22, if you see that they have sold almost 19 billion worth of shares in our market, which is just half of what we have received in previous year. Previous financial year, we got almost 37 billion worth of inflows from foreign portfolio investors, and now they have sold almost 19 billion, which is half of what they have invested last year. And if you see the foreign portfolio investors, in 1992, they were allowed to invest in our country. At that time, Manmohan Singh was the finance minister, Narasimha Rao was the prime minister. India was facing huge forex reserves problem. We have just a few billions of forex reserves problem at that time. So in order to increase the foreign reserves, at that time, Manmohan Singh allowed foreign institutional investors to invest in Indian equities. From there onwards, every year they have been putting money. From 1993 to till date, they have invested almost 170 billions of US dollar in Indian equities, and that is the investment value. And if you see the current market price of what they have made investment, a rough estimate shows that the current value is around 600 billion worth of shares foreign portfolio investors were holding. They invested 170 billion. The current market value is around 600 billion. And if you see that they have sold 19 billion from that. So out of 600 billion worth of shares they are holding, they have sold 19 billion. That is just 3% worth of shares they have sold in current financial year they have sold. So 3% out of 100 is not a big sell-off figure for as far as foreign portfolio investors are concerned. So we may see some more sell-off to happen. Maximum they may sell another 2%. So what my feeling is that majority of selling is over, and we may see only marginal selling from here on. 2 days back, I heard an interview from Motilal Oswal, Ramdev Agarwal. He brilliantly explained foreign investors just now are selling and leaving, and Indian institutions and Indian mutual funds, which is basically retail investors, they are buying whatever the foreign institutions are selling. They are easily selling and leaving the country. But if they want to enter India again, means they have to buy it at a very rich valuation. That is what his opinion is. I also feel the same, because in spite of heavy selling by foreign institution investors, our market is just 10% down from the peak. And if foreign institutions turned into buyers, means then price will go up very sharply. And this is the mutual fund inflow. and mutual fund inflow remain very strong. Almost 11,000 crores we are getting from SIP, that is systematic investment plan we are getting from. And if you see in the last month, the total inflow is around 19,700. So 11,000 crore is we got it from SIP. Around 8,000 crore we got it from SBI multi-cap fund, which is the NFO. So basically the SIP money is coming as well as the NFO money is there. Fresh inflow is not happening apart from this. Fresh inflow will be there. Similarly, some redemption will be there. So both are getting adjusted. So out of 19,000 crore, 11,000 crore is from SIP, and another 8,000 crores we are getting it. We got it from the SBI multi-cap fund. So one interesting thing is about the valuation, and many investors are asking whether can we buy it now market as well. One important thing whenever we want to buy is we have to see at what valuation our market trades, and this is the table. I will explain what it is. In 23rd March 2020, which is the COVID bottom, on that day only market bottomed out after the ferocious sell-off during the COVID crisis. Nifty PE was 17 and Sensex PE was 15. Till March 30, March 2021 on 30th, NSE used to calculate PE ratio based on standalone earnings of Nifty companies. On 31st March onwards, they shifted to consolidated basis, and that is why if you see that the PE ratio fell sharply during that period. On 23rd March, during COVID bottom, it was 17 PE, and March 2021, it is around 33 PE. But it started coming down 18th March, October 2021, which is the near-term peak we have seen in the Nifty, 18,400, 300, 400 range. At that time, Nifty PE was around 28. And if you see between March 2021 and October 2021, if you see that actually PE ratio has come down, whereas market has gone up. This is mainly because the earnings has gone up during that period. Price to earnings is the denominator is the earnings. So whenever the denominator used to go up, which is the earnings, then PE ratio will fall. So that is why if you see that in spite of higher Nifty range, the PE ratio has come down. And if you see it now, which is yesterday, March 2022, the Nifty PE ratio is at 21. That is from October onwards, Nifty has come down by almost 10%, whereas the PE ratio has fell more than 20%. The reason is that the earnings has again gone up in the last quarter. That is the reason why the PE ratio has come down a lot. So 2021 PE ratio is a reasonable PE ratio for a country like India. Generally, we used to bottom it around 16 times forward earnings. This is the current earnings PE ratio. So forward earnings means around 10 to 15% lower. That means we are trading around 18 times forward earnings, 18, 17 times forward earnings. So market used to bottom around 15, 16 times we used to bottom out. So maximum, if you see that maximum, our market can fall another 10% if crisis gets worsened a lot. But that is on a worst case basis, I am telling. But I feel that market may not fall to that range. So valuation looks reasonable based on current earnings. So one can start accumulating because the valuation looks very reasonable now. So what investors should do now? We are seeing war on one hand, on the other hand, inflation is going up. On the other side, crude oil prices and other things are very high. So what investors should do now? That is what majority of them ask. And if you see that any sharp fall in market is always a buying opportunity for long-term investors. If you are a long-term investor, you don't worry about near-term volatility, you buy it. Near-term, there may be some notional loss, but only in bear market, you used to get a higher margin of safety than in bull market. I have my own experience in that. I also used to put my personal money in the market. I used to buy 2 or 3 times in a year, and I never look into it. Rarely I will see my portfolio. Whenever market falls very sharply, I used to buy some shares. Whatever cash I am having, ideal cash I am having, I used to buy shares. Whenever the market is very weak, I used to buy it. Then I won't look into it on a daily basis whether the price has gone up or not. I accumulate the shares and I never look it. But in majority of times, I have seen that in my own experience the last 15 years, I used to make huge profit whenever I buy in the a sharp falls in the market. After I buy, price may come down again. But after 2 years, 3 years, if you see means price would have gone up very sharply, and many shares, after the price has reached a peak, it has fell by 50% also from the peak. But I did not sold it, but still, in spite of falling from the peak from 50%, many of the stocks uh, are still above my buy price. The main reason is that the margin of safety is very high in the bear market. So that is what my experience says. So in bear market, you used to buy shares. You don't buy momentum shares during bear market. Buy at least companies which are having some fundamentals. You buy it, and you will never lose money in the market. Even if loss comes, it will be very small loss you will make, which will be a manageable one. Whereas in bull market, if you buy means you can easily lose the 40%, 50% like that. So any sharp fall in the market is always a blessing for a long-term investor, and they should buy it. And the best way for them is to systematic way of buying is the best option. Right now, we are seeing globally an inflationary scenario and a fixed income, which is the bond market. During the inflationary scenario, interest rate used to go up, and fixed income won't do well, because whenever the inflation goes up, bond yield will go up, bond price will come down, which is negative for a fixed income group. So a part of money will shift to equities during the inflationary scenario. And some of the companies also do well in the inflationary scenario. Commodities companies will do well, and some other companies which are having pricing power, they will do well in the inflationary scenario. The sales will go up, and equities basically should do well in the inflationary scenario. And current price fall is a very good opportunity for long-term investors, and valuations also now reasonable. And this is the chart of the nickel, where the price went up almost 100% in a single day. So whenever we are in market, one thing we have to remember, particularly for traders, I am telling, that somebody who has gone short in nickel, he would have got wiped out if he doesn't keep stop loss. So for traders, keeping stop loss is a must and is a mandatory, and you have to accept at some point of time. You have to accept loss and you have to get out. If it doesn't get out, means you will permanently will be thrown out of the market. For to make money, you have to remain solvent. You have to be in the market, and for that, for traders, you should keep stop loss. You should take only calculated risk. Blind risk you should not take. If you take blind risk, and if things goes against you, miss, you will definitely will be thrown out of market. That should not happen, because market will always give opportunity to everyone. Everyone will get an opportunity to make money in the market, but at that time you should be in the market. If you lose all your capital and you are thrown out of the market, means then even if you get opportunity, you cannot make utilize of it. So this nickel is one of the greatest example where many people have lost their capital completely and they are thrown out of the market. So always keep stop loss, particularly for traders and short-term investors, because keep being in the market is one of the mandatory for an investor or a trader. So don't take blind risk. If there is any loss, accept the loss and remain and try to remain in the market. That is why I have put this slide particularly. So US Fed meeting is coming. Fed will hike rates in March 16th meeting, and previously it was expected that around 50 basis point they will hike, but due to geopolitical tension, the rate hike is expected to be milder, It is going to be 25 basis point hike in the Wednesday Fed meeting. And, currently, the bond yield in US has already gone up to 2%. In all this war, one major thing people forgot is the COVID crisis. Actually, in India, the COVID cases has come down, whereas still there are some alarming number of COVID cases in many countries. For example, Germany, if you see that daily 2 lakh people are getting affected in COVID. Hong Kong also we are seeing that many people are getting affected in COVID. So COVID, we cannot write it off, but luckily the current wave in India, we did not got much damage. So in conclusion, what my own expectation is that market will be in an accumulation zone in near term, unlikely to go up very sharply or come down very sharply. It is going to be the range bound. It's a good opportunity for long-term investors. The heightened volatility where we saw 1 week, 10 days back, where huge sharp fall in our market, that is behind us now. I don't expect huge volatility in the market. Market is likely to be range bound, at least on an intraday basis. I'm telling, we are not going to see huge volatility, and the market will gradually drift down or drift up. With many stocks will be in the accumulation zone. You gradually buy it with an expectation that to keep the shares for 1 year to 2 years. If you are buying a share expecting that the next week it will go up, or within 2 months it will go up, means you may get disappointed. We are expecting market will remain in accumulation zone in the near term, but it's a very good opportunity for long-term investor. And events to watch: foreign flows for the last 2 days, it has come down, and US Fed action, we have to see on Wednesday what commentary they are going to make. So this is what the current market scenario presentation, and I will take the recommendations now. So basically 5 shares I am recommending. The first one is the Hindustan Unilever. So Hindustan Unilever is FMCG bellwether. They have tremendous pricing power. When prices go, right now we are seeing many raw material prices are going up. Palm oil, which is one of the main raw material for producing soap, the price has gone up very sharply because of a huge shortage of sunflower oil. People are switching to palm oil, which is the main raw material. So if you see any whatever raw material Hindustan Unilever is using, the price has gone up, but they have tremendous pricing power. In the past they have demonstrated. So better stay with a market leader during this inflationary time, because they have pricing power. They will pass on gradually 2%, 3% hike like that they will make, and they will pass on. The price earning ratio is around 55, which we have seen 5 years back. At one point of time in the last 6 months, the PE ratio of Hindustan Unilever was almost 70 to 80. It was trading. Now that has corrected to 55, which is the 5-year low price earnings ratio for Hindustan Unilever. So as an defensive play, one can buy Hindustan Unilever. BEL, why we are recommending is that many countries now has shown intention that they are going to increase the defense expenditure. BEL is a PSU company which is supplying mainly to defense, and every government is going to increase their defense expenditure in coming years, because anytime anything can happen. All these defense projects will take many years to complete. So if a war starts, means you cannot, at that time you cannot manufacture a defense good. So we should be prepared 2 years, 3 years before that. So BEL, their order book is very strong. Since they are in defense area, we are recommending it. Hindalco, their aluminum is completely integrated. They have mines, bauxite mines they are having. Similarly, coal mines also they are having, and which where the Indian operations will get huge profit because of the sharp increase in the aluminum prices. Whereas their US operations, where they do aluminum cans and all, that may get affected a little bit because of very high aluminum prices. That may get affected, whereas Indian business will do well. Zydus Life Science, previously we have recommended many times. At that time the name was Cadilla. Now the name has been changed to Zydus Life Science. Actually, they missed the vaccine opportunity. We recommended mainly because of the vaccine, but the company approval got delayed, their manufacturing got delayed, so they completely missed the vaccine opportunity. But price has fell almost 50% from the peak. That means it is now available at a reasonable valuations, and the P ratio of 8, it is mainly because of one-time extraordinary income they have got it. But if you leave aside that extraordinary income, the company is currently trading around 17, 18 times current year earnings, and for next year basis, it is trading around 16 times, which is a reasonable valuation. And one can buy the Zydus Life Science because of we are having very high margin of safety, and similarly the research program also doing very well. Last week they launched one new product for treatment of anemia for kidney problem patients. So we expect because of high margin of safety, the price can go from here. Downside is very limited for Zydus. The final one we are recommending is Balrampur Chini Mills. Now, because of crude oil prices going up very sharply, ethanol diversion is going to happen. Brazil, which is the largest producer of sugar, they are going to divert more sugar to the ethanol. So sugar prices will go up. Similarly, in India, government is buying ethanol at a higher rate. So they will get double boost because of higher sugar prices as well as higher ethanol prices. So these are the recommendations I'm making this time. And last time, if you see, means GNFC did very well in spite of weak market. Yesterday, it hit an upper circuit. It is an F&O share. There is no limit for that. But temporarily, it hit an 10% upper circuit. And Cipla, it hit an all-time high yesterday. And it is technically also looking very strong. So Cipla and GNFC did very well. Garden is, in spite of market weakness, did not fell much. Only ICICI Bank and Reddington fell. Overall portfolio is down by 1.5%, whereas Nifty fell by 4%. So we have reasonably done, our stocks has done reasonably well in the last 1 month. Technicals, if you see that many of them are asking to me. So what will be the levels to watch out for Nifty in coming days? So if you see the near term, around 16,000 the channel support. This is the Nifty is trading on a downward channel, and based on that, if you see that Nifty has support around 16,800 level, resistance around 16,800 level based on the this channel resistance. And even if you see that our 200-day moving average, Nifty 200-day moving average is around that range only. So Nifty has a strong resistance around 16,800, and support, if you see, Nifty has a strong support around 15,650 range, where many times in the in the past Nifty got support at that time. So the near term resistance 16,800, support is 15,650 level. On a medium term, if you see, once 16,800 resistance is broken, the next resistance comes around 17,750 level. Then we have the all-time high of 18,600. So 16,800 is broken, means the next resistance is 1,000 point away, which is 70,750 level. Support, if you see, 15,650 is the support. The next support is 14,200. And if any worst case scenario, 12,400 is the last support, which is on a worst case scenario. But my feeling is that Nifty unlikely to fall below 15,650 unless there is a world crash happen. Globally, huge crash happens in our market. Nifty may drag down gradually to 15,650, 15,500 level. Beyond that level, index fall is unlikely, because there is some valuation support also there at that point of time. And Fibonacci retracement wise, if you see that this is the low with COVID, this is the COVID low which has happened, that is 7,000 3,400 level in March 2020. From that, market went up very sharply. Now it has corrected just to 23.6% retracement it has done when you compare with the COVID low and recent high. So only a marginal correction has come. If you see the entire rally between COVID low and the recent high, so then there is nothing to panic in that. It's a normal correction in the long-term bull market. So this is what our recommendation is.